UK inflation jumps by more than expected in January. Well, the CPI reading of 3% is likely to test the theory that price pressures in Britain are easing, though sterling seems unmoved by the surprise release. James Smith is a developed market economist at ING. James, what's your take on this release? It's worth digging a bit deeper, isn't it, as there's some comfort for policymakers at the Bank of England.
There absolutely is, because yes, headline inflation is back up to 3%, but the reasons why we've gone there is down to things that the Bank of England doesn't really care about. So food prices surged in January for no obvious reason. Private school fees went up because of tax hikes as well. That's quite a small story. But when you really centre on the things that they care about, service sector inflation, that did bounce back up to 5%, but only because there's something a bit weird going on with airfares last month. And actually, when you dig a little deeper, when you think about what you really think of services, restaurants, catering, that sort of stuff, the inflationary pressures are easing. So as time goes on, this should be better news for the Bank of England.
So does that still mean they're on for multiple rate cuts? And if so, how many this year?
Yeah, I think so. So we've had one, of course, this month. I think the path of least resistance is for a rate cut every quarter this year, so 4 in total. Markets are not a million miles away from pricing that now. I think there's about 2 more cuts fully priced. I think where the more interesting question is what's priced for next year. Markets still think rates will only go to the sort of 380 area, whereas I think we're going to get closer to 3%, 3 to 3.25. That's probably where we differ more from the market right now.
But how could tariffs actually steer the Bank of England off course? We've just heard that the president of the US wants to introduce 25% tariffs on autos, pharmaceuticals, and chips. Are there any signs in today's data that this trade uncertainty is having an impact yet?
I think not as of yet. I mean, the key question, just looking at it purely from UK inflation, is it's not so much what the US government does, it's what the UK government does in retaliation, because ultimately, tariffs end up on your own, hitting your own consumers. So I think that's still an open question. Also, an open question as to whether or not the UK can dodge the worst of the tariffs from the US, whether the UK manages to sort of separate itself from the rest of Europe. I think whatever happens, fresh tariffs are coming in. There's clearly an appetite in the Trump administration, both to raise more tariff revenue, but also there's deep-rooted sort of grievances about trade deficit. So tariffs are definitely coming. I think it is a bit of an uncertainty, though, for inflation.
But ultimately, do you think that the president's trade policy puts him at odds with his own desire for the Fed to cut rates?
A little bit, yeah. I mean, it looks like the Fed is going to pause their interest rate cutting cycle. We do expect rate cuts to resume later this year, though. I mean, when you think about what tariffs mean for the US economy, in the short term, it's higher inflation. You get a sort of one-off increase in the price level. But over time, if there's not an offsetting increase in, on the fiscal side, so if you get a big boost of tax cuts coming through, if that doesn't happen, then consumers are left sort of footing the bill, and what you end up with probably is just lower growth, and therefore maybe even a bit of sort of lower inflation across the medium term once that tariff hit goes. So I'd say that the inflation story is a little bit nuanced. It is a big short-term increase. I think that's giving the Fed pause for thought, but we do expect further rate cuts later this year, as I say.
And that was James Smith from ING. Don't forget, you can get more on Reuters.com.